And joining me on the podcast right now and on video, Russ Mould, investment director at Stockbroker AJ Bell, and he shows me up in the dress stakes anyway, because he's looking very smart there, Russ.
Yes, thank you kindly. And I've done a couple of bits and pieces internally this morning. Although I must admit, house style is actually no tie at AJ Bell.
Is
And I'm
it?
just a bit of an nostalgia. So I just put one on purely out of habit and forgot that house style was no tie. So I've got one on. So,
Yeah, but if you do that, see, Russ, you stand above the rest. You stand out. You've got that extra
well,
yard. So,
fashion comes and goes, but true style always lasts, as Coco Chanel once said.
yeah, exactly. Let's have just quickly. Let's go to the FTSE 100. This is an all-time high here in the FTSE. It's which is nice to see. And I suppose a lot of this is down to the pound dollar, isn't it?
Yeah, it is. And I noticed that the Financial Times today, in their irreverent Alphaville column, did point out that the FTSE 100 is not at an all-time high in dollars, euros, market cap, or inflation adjusted terms. But we'll come back to that in a second. It is at an all-time high, and the short-term catalyst for that, as you absolutely said, Justin, is the weaker pound against the dollar and the euro. Why is it weaker? Bit of geopolitical, because people are flocking into haven currencies like the dollar. Political uncertainty in the UK. Economic numbers have been okayish, but not amazing. And the US economic numbers, by comparison, much better. And there's this theory now that the Federal Reserve will be much slower to cut interest rates than the Bank of England. So the interest rate differential between the dollar and the pound favours the dollar. So
Yeah,
that's why the pound's going down. What does that matter to the FTSE 100? Well, 2/3 of FTSE 100 earnings come from overseas. So it's just maths. If the
yeah,
pound goes down by 4 or 5%, roughly the earnings will be increased by a similar degree. So it's like walking into a shop and finding all the chocolate bars are 5% higher for the same price. What are you going
yeah,
to do? Well, you're going to show some interest in that, aren't you? So that's the short-term mechanics, mathematics of it. It's largely down to currency.
yeah.
Longer term, the FTSE 100 feels like it's underperformed America and Europe forever.
Mhm.
There have been times when it's outperformed, but underperformance means unloved, and unloved can mean undervalued. And
Yeah,
ultimately, the price you pay, the valuation you pay for a security and to access your share of its cash flows, that will be the ultimate arbiter of investment return. The lower the price you pay, the better it is. And although investors haven't been too interested in UK equities for a bit, private equity has been, trade buys have been. 15 takeovers in the UK this year, average premium 57%. 40 or 50 takeovers for the last 3 or 4 years, average premium 40 to 50%. The market just might be cheap, and that might be one reason why it's finally going up, because investors are thinking, yeah, there could be some bargains to be had here at a time when, let's face it, the US has done really well. It's on twice the earnings multiple. The US is now 60% of global market cap. That's back to its all-time high in 1999, 2000. That didn't end very well.
mm,
And 1/3 of US market cap is just 7 companies. So you've got a very lopsided market. What happens when everyone's on the same side of the boat? It
mhm.
eventually tips over. So either it tips over or people start moving back to other bits of the boat. Maybe, just maybe, that's what we're seeing now in the US as well. Certainly the results from the Mag 7 will, in the next week or so, will be very interesting reading.
Wow. Do you know what? Your capacity for figures, your brain,
How's that?
astonishes me. It's literally, it's amazing. I'll have to rewind, listen back to this and get some of the figures. But do you know what? Yeah, regardless of all that adjusted, the people say, oh, inflation adjusted or in dollars terms, what this does, like I said, I've heard several headlines, people say FTSE at an all-time high. It does, raise attention towards the FTSE.
Yes.
And then people look into, like you say, and you realize it's twice as cheap as the S&P 500. Okay, the S&P 500 has done treble, I think, that what the FTSE performance has done. But also the dividend yield for FTSE is around about 4%, whereas the
Yeah.
S&P it's around about less than 1.5%, I think. So
Good.
like I said, you will see, I assume, like I said, money inflow because of this. Because okay, it's starting to rally now. Finally, it's starting to go.
And
So it
that
does
comes back
create
to the
attention.
valuation point. So if you, I mean, so
Yeah.
the yield is, as you say, about 4%. There or there, give
Mm.
or take, maybe a little bit lower, depending on the numbers you use. But if you then look at, say, last year, share buybacks added about another 2.5% to that in cash yield, and takeovers another 1.5%. And we're on track to do that this year already, looking at the buyback numbers we've had declared and the takeovers we've got. Now, things can change, but 4% plus 2.5% plus 1.5%, that's an 8% cash yield on the FTSE 100.
Yeah.
Beats cash in the bank, beats inflation, beats 10-year gilt yields. That, again, is suggestive of an attractively valued market. And why are people demanding that high yield to own UK equities? Because they think there's lots of risk. So if they get more comfortable with UK equities, they're prepared to accept a lower yield by paying a higher price. And if they're paying a higher price, the market's going up. So again, if people feel that get more comfortable with it, they'll demand less compensation and pay higher prices. And maybe that's the process that's starting as well. Again, we'll see, but we will see.
Yeah, well, I'm happy because I literally I'm largely in microcaps, but I do have the biggest holding I have is a high yielding dividend fund, which is FTSE 350. So it's the biggest stocks that yield the most amongst the things. So yeah, and that's in fact that's outperforming some of my microcaps at the moment. That fund. So
Wow.
I'm happy with that anyway. Talking
Yeah,
about it,
again,
sort
if
of,
interest rates do come down, then yield stocks and bond proxies will potentially be a little bit more in favor because again, if the
yeah.
return on cash is lower, the return on the yield on bonds is lower, people will be inclined, obliged even to look, say
Yeah.
maybe take on a little bit more risk and look for other options, which could include yielding equities. So again, higher interest rates have hurt some of those companies over the share prices over the past year or two. Again, if the Bank of England sticks to the script, that could start to reverse.
hmm What do you think about this? I mean, I think we've mentioned this, but there's a lot of people saying now that because the US have pushed out their decision on reducing interest rates because their economy is strong. Unlike over here, in fact, the PMIs came out today in the UK, and like I said, we are a service, about 80% service-led economy. So the services PMI very good, above estimates. If it goes above that 50 level, 54.9, predicted to come in at 53. Previously, it was 53.1. So that's good up. Manufacturing isn't very good. It's now dipped below again that 50 level. It's now at 48.7, but the composite is 54. So do you think the Bank of England is sitting there, and maybe the ECB, waiting for the Americans to move, or because they got different economies, or do you think they'll move on their own?
I think generally you've seen them move fairly much in unison in the past 4, 5, 10 years. But the Bank of England, Governor Andrew Bailey was at that IMF World Bank junket in Washington, D.C. last week, and he was looked to be laying the groundwork for the Bank of England moving early, or at least saying, look, we'll do this on our own merits, thank you very much, not according to anybody else.
Yeah.
Equally, as we're seeing, if the Bank of England goes first, then you might get the pound weakening, that increases import costs, and that in turn boosts inflation. So they do unfortunately have to think about what's going on in the rest of the world, not just what's going on within these shores.
Yeah, yeah, yeah. Talking about small caps, I read an article in the Guardian this week about AIM, and there's 73 companies I think in the last this year, last 12 months I think it was, have delisted.
Correct.
A lot of these companies though are high cash burn, they're loss making, they're finding it hard to raise money in the market, which is what the market is for pretty much. But I just say, and there's this worry about the future of the AIM also. And in fact, even the UK stock market as a whole, because some companies are going over to the US. I just think this is a natural function of the markets. When you have it, you'll be surprised how many charts I've looked at where of companies are listed in 2021, top of the bull market, and now they're in big trouble because, of course, when money was cheap and everyone thought the market was just going higher and higher, and that's it's the opposite of the old adage: buy low, sell high. People were sort of listing because everyone wanted to invest at the top of the market. Now it's down the bottom, interest high. The companies that are not making money are struggling to raise money.
Yeah.
So, is it a natural function of the markets? I mean, nothing to be worried about,
Yes.
is there really?
No, not at all. And if you think about it, if their business model is only viable when money costs nothing, they're in trouble.
Yeah,
And now you've actually got something that's vaguely akin to a believable weighted adjusted cost of capital with interest rates at 5.25%. Businesses that needed free money to thrive, in my opinion, we're always going to get found out that's probably happening now. And I
yeah,
know it's unpleasant for the people involved. Nobody likes to think of anybody losing their job, but that's the natural warp and weft. And if anything, there is an argument that central banks, by pouring money at everything and doing their best to avoid a recession, have
yeah,
actually warped that scenario. So you haven't had that kind of creative destruction, that Schumpeterian creative destruction, which means that, necessity is the mother of invention. If
yeah,
there's no crisis and the solution is just more cheap money, maybe that's why productivity is pants, because nobody's under pressure to do anything about it. So I
yeah,
think
yeah,
that normal wave of recessions are part of the normal cycle. We had what, a dozen in the last century, and look
yeah,
how much economic progress was made.
yeah,
Doesn't mean
yeah,
they're funny. Doesn't mean that,
yeah,
again, it's good news for those that lose their jobs, but we adapt. You can't say we can't have a recession. It's like saying, well, we can't allow Cartwright to be put out of business by Ford Motor Company. We're going to stick with horses and carts. That doesn't make any sense. So I
yeah.
think it's naturally self-policing. It is natural self-selection. It is natural selection. And yet, if companies can't make it, can only make it when the cost of money is nothing and money's free, they're going to get badly found out eventually. So I think that's probably a healthy thing because it means that capital is being, it sounds cruel again, but capital is being freed up from zombie companies that can be more effectively deployed by other companies that are thriving. Thank you very much.
Yeah, yeah, it is that. I mean, it is zombie companies. Like I said, that environment where money was just free and placings were easy to do. It just does prop up those zombie companies. And like I said, what's good now is that those companies will obviously who have gone through. It's not a good thing for, like I say, for the people involved, but the strong get stronger. You know, the real good businesses, well, those little businesses may take them a little bit of share their market, will be gone, and so the strong companies will get stronger, and the weak companies, of course, will
Yeah, I
delist.
mean, if you
By the
think
way,
about it from a bank's point of view, the worst of loans tend to be made at the best of times
yeah.
because that's when that's when you're you're most relaxed, you're most comfortable. You think this is easy, and it's the same with stock market. Speculation's at its most dangerous when making money looks easiest, as Mr. Buffett always says.
Yeah, look at that. That's the AIM all share. Now that's down 49% over the last 780
Mm.
days. That's from the high to the low. By the way, we're now it's now 900 odd days since it's been a heck of a long bear market for AIM. You know, it's 900 days. That's long, isn't it? Compared to even the Great Financial Crash wasn't that
Yeah,
long.
that's not funny.
And but you see here it is changing. We are seeing now it's up about 13% above 200 moving average. And for the first time ever, this 200-day moving average is sort of flattening out.
Oh,
It's
that
been
makes a
down,
change.
down, down for a long time. So we may, and someone did say to me, I did post on X there, said FTSE at an all-time high. Someone said, pity about AIM. I said, the trouble with AIM, it's a stock pickers market. It's not an indices you could invest in entirely because there's a lot of rubbish on there. And that rubbish tends to, but there's a lot of good companies on there. Because I know, I look at them, but the trouble is the rubbish drags down. You know, the good companies, it's very it's very two-thirds, I'd say, or a third are absolute rubbish. Maybe a third are okay and a third are quite good. And so you've got the two-thirds sort of dragging down the indices, you know?
And again, if you look, if people are just starting to feel comfortable with the FTSE 100 again, you talk about that
Yeah,
risk profile, why they're demanding such a high yield or cash yield as compensation for the risk. If they're just feeling comfy with big caps, that
yeah,
will take time to filter down to mid and small caps. But if you
yeah,
get that is their natural progression. It might just take a bit of time if things continue in their current trajectory.
yeah, exactly. Marvelous stuff. And what's any other news? So some M&As there, but that's
Yeah, I
you
mean,
know a
we
sign
saw
that
one in AIM yesterday. I must admit, what I know about base resources can be written on
no,
the
I
back
didn't
of a
know anything
stamp,
about.
but I did
Yeah,
see 188%, which is fairly eye-catching.
yeah,
And
yeah,
again, those 15 takeovers we've had in the UK this year, the average takeover premium has been more than 50%. So
yeah,
again, either private equity or trade buyers do think there's value to be had in the UK. That's mainly been mid-cap focused. There's been one mega cap, which is DS Smith in the FTSE 100,
mm,
one smaller cap base. But again, it does suggest that there is value to be had if you dig around. And I think, again, the UK market, you can make the case it is cheap. Then you're wondering, well, what will make it less cheap? Why does it deserve to be less cheap? I mean, the pound is a help to a degree, lower interest rates is a help to a degree. But equally, if you look at the last 10 years economic environment, low growth, low rates, low inflation, UK is not suited to that. It's full of
mm,
short duration, hard asset, short duration consumer and cyclical plays.
yeah,
It's perfect, that low growth environment. It's perfect for long duration secular growth story that America's packed with. But if the world's now turning around from low growth, low rate, low inflation to high nominal growth, higher inflation, higher rates, the UK market might not look so daft because it's packed with short duration cyclicals and it's packed with oils and commodities and miners. So again, if
yeah.
you think the macro environment's changing, UK might get a bit more of a sniff than it's had for the last decade.
Yeah, yeah. Well, that's the point that someone said, why are you invested in that fund? I said, well, it's underperformed. It's FTSE 200. And I said, let's be honest, the last 12 years hasn't been really conducive to FTSE 100 companies, but it's going
Yeah.
to change. And I think, after it's everything cyclical, isn't it? You go from
Yeah.
one extreme to the other. And like I said, I agree with you completely on the central banks. What they do is fuel the problem because they tend to reduce interest rates to nothing and they pump them back up. And you think, well, what happens if you just left them at 2% and just let the natural, market economies take place, let it happen. I often wondered that because it's literally, it's like I was thinking of this, walking the door, I was thinking it's like having a little campfire and it's going nicely, and someone comes along, just put some petrol on that, just get it going, and throw some petrol, it goes nuts, and then they run back and say, oh, put some water on it. So calm down, you shouldn't have gone from one extreme to the other. It was going okay, so it's
Yeah.
almost like that when they exacerbate the problem of the extremes.
I think they have a difficult job, but I don't think when the history books get written that they'll be seen to have necessarily helped. I understand why they're terrified of a recession now, because there's so much more debt in the system that could quickly become a deflationary spiral. So if anything, if they have to take a chance with either deflation, a recession, or inflation, I'm pretty sure they'll take their chance with inflation, because that will also help erode the debt in nominal terms. So I think that's again why I do feel personally, and this isn't advice, it's only my opinion, that the economic environment may be different in the next 10 years, and that we are going to be different from the low growth, low rate, low inflation mush that we've had, and that we will see a different environment in the next 10 years, just because the debt means we really would struggle with any risk of a recession. And that means that central banks and policymakers will maybe more inclined to take their chances with growth and inflation, so they can stave off any recession that would make servicing the debts extremely difficult.
Yeah. Okay, marvelous stuff, Russ. And I'd be willing to bet that maybe the FTSE will hit 80-100 by the time we speak next. It's literally pumping up there. He may have to go sideways a little bit, but
yeah, I was going to say at some stage there'll be a bit of a retrenchment and a retest. But if I defer to the technicals on you completely, but let's see how this one.
It is looking a bit overcooked. But well, in fact, the RSI's relative strength isn't near overbought levels, and we've had 1, 2, 3, 4, 5 positive sessions now. That's quite good.
That's compared to 7 down days in a row from Tesla. That's interesting.
That's dreadful in Tesla. I know. Well, he's up against them now. In the Chinese, EV players, they can produce these cars like £10,000, thinking, and they're quite good quality apparently. They're quite good. But anyway, just another stat, by the way, before we go. In this country, I don't know if it's a policy change or whatever, but it seems now demand for EVs has dropped off a cliff. And I'm just hearing that if you charge at home, it's about 2 pence per mile it costs you. If you go out and do a public charge now, it's costing you about 20 pence, so 10 times as much. And yet for diesel, it's 19 pence per mile. So then, they're not going to take off for the EVs if they're more expensive to charge than filling up your car with petrol or diesel. So,
that's a challenge.
Yeah, exactly. Marvelous stuff. Thanks for that, Russ. Speak next
Pleasure.
week.